Well, good morning, good afternoon, good evening, wherever you are. Welcome to Breakout Trading Answer, the show where we talk about all things breakout trading. And of course, we've got our special guest, breakout trading specialist, Mr. Breakouts himself, Thomas Nesnedor. Welcome, Thomas.
Knock, knock. Anybody there? Anybody there?
Hi, guys.
Yeah.
Nice to see everyone. It's great to be back. We have a lot to talk about tonight. And I wonder who's here with us tonight?
Let's see. Let's have a hello in the chat to Mr. Breakouts. Good morning, good afternoon, good evening. I'm seeing nothing in the chat right now.
Nothing yet. Maybe a delay.
Yeah.
Yeah.
Thomas, I think you just muted yourself.
Oh, sorry.
There we go.
Knock, knock.
Let's start again, shall we?
Yeah. Okay. So before we get some answers, I have something interesting to share. So,
okay.
Yes. So believe or not but I haven't had any major trading idea for, I don't know, more than a year and a half. One of my last major breakthrough and major ideas was the dynamic profit taking. And since then, for a long time, I haven't had any prolific period where I would be able to come up with something neat and cool, which is unusual. Normally, I used to have a lot of ideas during the year all the time. But finally, it got back. Finally, yes. So finally, after a long time, I got an idea on Monday, which of course now I need a couple of months to work it out. And I started planning the idea and how I will process. I think it's a pretty neat idea. I think it's something very new that I've never tried before. And I don't know about any other trader who tried it before. But what I want to share, and this is quite interesting. So yesterday morning, I sat down and I broke down all the steps that I need to do next to start testing and executing this idea. And would you believe what the first step is?
What the first step is? No idea, actually.
Right.
It's too early in the morning here, Thomas.
Yeah, I know. I feel you. So the first step is actually importing the data into Excel spreadsheet.
What?
To perform some overall basic analysis.
Wow.
And I found it totally incredible that in today's world of super high technology, I still keep going back to Excel spreadsheet, but it honestly serves the best purpose for this kind of analysis I need to do out of all the fancy, expensive, whatever cloud, hyper-speedy solutions that I've ever tested. And it really got me thinking, because I was like, I can't believe that it's 2022. Elon Musk is about to conquer the Mars pretty soon. We have so much technology everywhere, and I'm going back to the spreadsheet. But it served the purpose, and it serves the purpose perfectly. And I really realized, we have very often we have discussions with traders like, what is the best software? What software should I use? Battle of softwares. And it's so simple. It doesn't matter. You just need to use a software that serves the purpose of the particular task that you need to do. It really doesn't matter which software it is, because quite honestly, with most software, you don't use 99% of features most of the time. You just use the one thing that, like with Excel spreadsheet, I need to do one or two. I need to use one or two things that I need to quickly write in macros. So I found it quite interesting because I know that recently we had a discussion with somebody. Oh, actually, it was on the Hangout. I don't know who it was, but he would said, like, should I move to TradeStation or not? Well, why not? Like, whatever serves the purpose, right? Like, we sometimes Excel serves the purpose, sometimes TradeStation. We shouldn't be stuck with one software and try to do everything there, but just it's a tool, whatever serves the purpose. So I wanted to share this, that I'm back to the Excel spreadsheet. How awesome is it?
We've got a comment in the chat from Olga. G'day, Olga. Let me put this
one Olga,
up.
Nice to see you. We haven't seen you for a while. We're glad that you're back. Very nice to see you, Olga.
Yeah, and the comment, simple things are the best. And that reminds me actually of a blog post you published, Thomas, probably about 5 years ago, I think, on the Better Trader Academy website, and I think the title was something like the best trading tool ever or the most simple trading tool ever. Do you remember what that was?
I know.
People were
Yeah,
quite
paper and pen. Yeah, and I since then I upgraded. I use the Remarkable, the digital paper, but only because it really does feel like a real paper, and because all my notes and ideas can be in one place. Otherwise, I was, using 5, 6 notebooks at the same time and having them everywhere, so it was a little bit messy. But still, the best tool. Yeah, absolutely. Now with this new idea. Next 3-4 weeks, I'm going to spend just with this digital paper and thinking it out and planning and drawing how to execute the idea. Still the best one.
Yeah, absolutely. All right, so we've got some hellos and welcomes and comments in the chat. So how about we say hello before we move on? So according to my screen, Gary was the first one to say hello, but I can see in YouTube there were some comments before that. So we had some kind of delay. So apologies for that.
Okay, yeah, we had.
So g'day, Gary. Jeffrey, good to see you here. Olga's back. I don't think we've seen Olga for a few weeks, as you mentioned. So
yeah, Olga, we missed you.
welcome back, Olga.
Definitely.
We did miss you. Gianluca, Juan, g'day, Juan. Oh, we got a comment here from Jeffrey. We're going to have a look at this one. The dynamic profit taking program is amazing. Thank you for sharing that with us. I agree. That's
Great,
one of your best bits of work, Thomas. Dynamic profit
Yeah,
taking.
I think so as well. Thank you, Jeffrey. I'm glad you find it helpful.
Huts would like to know, do you have any new courses in the pipeline? We've got something exciting in the pipeline.
Not me. That guy talking to you, he's got something major in the pipeline, and it's very exciting.
Yeah. But I'm talking about we've got a special announcement next week, which will...
Oh, yeah, that's going to be major.
I think we might mention a little bit today, Thomas.
Yeah, we will later.
Yep. Okay. So there's some stuff coming, some exciting news from Thomas coming. Okay. So it was a good little chat about tools, Thomas, because that often comes up, and sometimes I think people like to overcomplicate things. We've got people who are trying to build their own. What's the phrase you use? Build a rocket ship to do.
Yeah, spaceship. Yes.
Yeah. Build something overly complicated to do a simple task. So it's always a good reminder to keep things simple. So now, the topic of the show today. Well, actually, we're in a new series. I think this is the second one in the series, How to Stop Losing Money, and we're going to talk about different aspects of trading. What is the focus of today's episode, Thomas?
We're going to talk about failing strategies, and just let me make it clear, we'll probably get to this topic later again because there are so many aspects, but we have to start somewhere, right? So this is like the introduction part to failing strategies. All right.
So Thomas, a bit of background. Why did you choose this one as the second one?
That's a very good question, because you know that I have a list of topics that I would like to cover. There are plenty of them, and I would say it's a little bit funny reason, but I was thinking, like a lot of the upcoming episodes will go to certain more detailed aspects or more subtle aspects of trading craft. So this one is a little bit, as I said, like an introduction. And then we gradually should continue into more subtle details with different aspects with next episode. So I felt like this is a good one for the second one, where we will cover a broader view on this concept, and then we will talk about false breakouts, for example, in one of the episodes, or the right trade management and stuff like that.
Yeah. I think also this is a good one to cover early on, because we all have to go through it, right? It's a part of trading. We have to know how to, if we don't know how to manage failed strategies, it can basically kill our trading account and, lose our confidence. And, back in 2008, I was trading mean reversion strategies on US stocks, or we use CFDs here in Australia, which I know in some countries aren't allowed. But I was trading on heavy leverage, and I had some failed strategies and blew up my account and stopped trading for a while. So thank goodness I got back into it. I got myself together, but failed strategies can have a really big impact on trading, and it can even cause, I imagine, a lot of traders to stop trading altogether. So this is a fantastic topic to cover, and I was just having a sneak peek at the slides, Thomas. I can't wait to see. You got some good points in there, so I can't wait to see it in more detail. So shall we get started?
Yeah, let's get to it.
Okay.
We have a lot to cover. So first of all, when we talk about failed strategies, this is what I'm talking about. Just to make it clear, I think this picture is worth 1,000 words. What I mean is a strategy which you create, optimize. It looks great on backtest. Even the out of sample compile equity looks great. You run it live, and this is the result. So this is failing strategy. Now, if we talk about failing strategies, it's not just about what to do, but it is about three specific steps. The first one, we need to understand, did it really fail? Because I think you will confirm, Andrew, from your own experience, many times we don't know. Many times we are in the gray area where it might look like it's failing. We switch it off, and then it recovers and makes a lot of money in a very short period of time. So that's a tough one, and we need to know whether it is failing or not. Second, we need to understand why strategies are failing. This is the most important part. And third, we need to have a plan what to do if our strategy starts failing. Sorry. So let's have a look on top three approaches to identify if your strategy is failing. So the first one is pretty simple, and it's exactly what I showed on the visual, on the picture, and it is visual confirmation. And this, I think in today's quantitative world, there's a lot of unnecessary eagerness to have everything exactly quantified. But we all know, like more experienced traders, we already know that discretionary evaluation still got a pretty big role even in quantitative trading. For example, where you're constructing portfolios, you do use a lot of discretionary assessment, looking on equity, on the quality. And it's very important because we learn from these visuals as well, and we are creating cognitive remembrance in our brain, which help us later on to identify if we feel something might be slightly off. So believe or not, but I'm still using this one. Sometimes when we have a chat in our hedge fund, is this strategy failing? We just have a look visually. And sometimes the picture is so pronounced and so radically self-explanatory that we know that strategy is failing. And it's especially a situation where the right opposite of what you've been expecting happens. When you have a steadily rising equity up, and in live trading, it starts going rapidly, massively down. So that's the first one. And it's important not to underestimate this one. It's a very, very strong one. Then, of course, on top of the visual, and from my perspective, it almost is secondary, we have quantitative approach to identifying whether strategy is failing or not. This is a vast world where we can spend hours and hours of research and chatting about and talking and covering many different aspects, but we always have to start somewhere. So one of the first important thing is if we even have the right sample size, sufficient sample size to really determine whether it is a failure or not. Because 1, 2, 3, 4, 5, or often even 10 trades do not tell us anything. Statistically, the least statistically valid sample size is 20, at least from my findings and my experience and my rules. So whatever is going on, you should fulfill at least 20 trades sample size to be able to quantitatively say this is failing. Because sometimes the first 10 trades can go steeply down, but then the equity curve can recover very quickly. And on the trade number 20, we can be back to new equity high. So that's the first very important quantitative measurement. If we have sample size at least 20 trades, ideally could be, for somebody it can be 10. It depends on the strategy. For me, breakout trading strategies, the approach I do, it's 20. Now, the very, very basic rule that I used to use before more advanced and more complex techniques for many years was a very simple one. And it was, is the drawdown already bigger than the world's historical backtest drawdown? And I used to have a rule of 1.5 times. So if my maximum drawdown, backtest drawdown was 5,000 and the strategy got into 7,500 drawdown, I would switch it off. And again, this is not the best quantitative approach you can create, but it's definitely simple. It's a good one to start with, and it worked for me for many years. And you can adjust this rule, but you have to stick with it. You must not change it. You ought to choose one, have a reason why you choose this one, and stay with that. And then the third element that is a little bit, I would say, unknown, or not many traders know about it or use it, is the speed of failure. Basically, if you create a strategy, you know from your backtest what is the normal length of drawdown, or how fast does it take to get to that biggest drawdown. Even if you use Monte Carlo analysis, you get quite a few ideas how fast your strategy can get into drawdown. And this is more advanced. This is for more advanced traders who already know how to play with these advanced ideas. So what you do, you measure the speed of this failure. And if the drawdown is happening too fast, too big, compared to your profile, then you know quantitatively that you're probably in troubles. So that's the second one. Then you, of course, combine visual and quantitative. And the third one is what I would call internal rules. And here it is very individual, and it comes out from an experience. So, for example, sometimes it can be a simple rule like X trades weeks or months without a new equity high. So, for example, if you have a day trading strategy which is supposed to make a new equity curve nearly every month because it's got a high frequency of trading and it's always in position and it's a huge sample size. And then if you have a time where you are in drawdown for 3, 4, 5 months, there's probably something wrong about it. And I used to have strategies like this, which were supposed to make a new equity high every 5 to 10 weeks. And I didn't, the equity curve went sideways for 4 or 5 months. So I switched it off. And eventually it did recover and it kept going up. But I really didn't regret the decision to switch it off, because I was able to use that part of capital and allocate it into more dynamic strategy, which fortunately performed well within the expectation, and use the capital a smarter way. So that's one of possible internal rules. You can also use some equity moving average rules. That's quite popular. Never worked for me. Never ever. I done billions tests on this, and equity moving average on equity never worked for me, but might work for a different approach or a different trader. Or you can have some very advanced Monte Carlo analyst based rules. The point is, whatever is the set of rules you create, you must stick with it. You must not change it on the go, because then you create total mess, and then things got rather significantly worse than better. So even if it's sometimes painful to stay with these rules, and we're not always right with these rules, and we will have occasions where these rules would prevent us from recovery, or other rule would give us a better service than the rules that we chosen. The truth is that we chosen these rules for a specific reason, and we spent time thinking about them, and we know why we deploy them, and we have to stick with them when drawdown happens. So these are the 3 areas of criteria to identify that strategy is potentially failing.
Yeah. Okay. Thanks, Thomas. So we've got some questions in the chat here. So maybe we'll just go through these 3 steps in a little more detail before we move on. So if we go back to the first one was visual. So I imagine that this example that you've chosen here is quite obvious, right? It's completely changed direction. But what about there's probably some nuances there that are really only identifiable by experience once you've got a lot of strategies and equity curves. So for like a beginner trader who perhaps doesn't have that much experience, or someone who doesn't look at a lot of equity curves, how can they incorporate this without having that that experience over the long term of looking at these type of things to being able to identify it visually?
That's a tough question to answer because experience is important part.
Yeah.
Yeah, I would say if you still don't have experience, for example, when I started with quantitative trading, with algorithmic trading, to speed up my experience regarding failing strategies, what I did, uh, I created a bunch of strategies which I never traded live, but I was tracking them on TradeStation.
Mm.
So I remember I had a workspace where I had like 20 or 30 other strategies which were never seen my live trading account, and I knew that some of them would fail, and I was assessing and analyzing these strategies as frequently as I was this on my live trading, and very quickly I got a good I got into good touch with these equities and started to learn how to recognize failing, stagnating equities, and it helped me to develop all these rules that we use in the hedge fund right now. And thinking about it retrospectively right now, but we basically keep doing the same thing, just on a much bigger scale in our hedge fund, because whatever strategy we create, we keep it in database, we regularly update it. We go through these strategies frequently, and believe it or not, I still go through hundreds of equity curves visually, because it's still a great exercise and important exercise for me to get feeling about the visual discretionary part. And I know that a lot of people, especially programmers, they freak out when they hear, oh, how do I quantify it? I'm a programmer. For me, it has to be 0 or 1, which I completely understand. But believe me, even my guys in hedge fund who are totally 0-1 programmers, they've developed a feeling for equity curves rather quickly. And what helped again was tracking a good amount of strategies. So that's what I would recommend. Like create one workspace in TradeStation, track 30, 40 strategies. In 2-3 months, you will start getting good sense of different qualities of output.
Yeah. Okay. Thanks, Thomas. So if we go on to the second slide now, we've got a question here from Olga. When you're talking about the historical drawdown backtest here, Olga said, "Do you mean here Monte Carlo drawdown?"
No. Here I meant just out of sample compiled equity without Monte Carlo.
Right. Okay. And how did you come up with the 1.5 times rule?
Quite honestly, I don't remember because it was 11 or 12 years ago. I just remember it was when I used to live in Portugal.
Yep.
So I don't remember all the details, but it worked pretty well. For what it was, the simplicity, and to start with, it worked pretty well.
Yep. And then also this third point here, where you're talking about the speed of failure. Are you talking about the speed in like the number of trades, or the speed over time, weeks and months, or how are you measuring that speed of failure?
Right. As I said, this is a very advanced concept that we
Yeah.
spend quite a lot of time on in our hedge fund. But basically, from your backtest or even Monte Carlo sampling, you, for example, know that your biggest drawdown, let's say, is $10,000, and you know that the fastest way to get into 10,000 is, let's say, 3 weeks. But you also know that to get half that would take, let's say, 1.5 week. And then if you experience, so you create a profile, and you know what are some boundaries. And then if you start getting into a situation where in less than a week you hit 5,000, you need to start paying attention to that strategy. And if the speed of rate keeps being way out of the profile, then you potentially have a very quickly failing strategy.
Yeah. Okay. That looks to be. We had a question from Hutz about equity curve trading, which you've covered already. And there's another question here about monitoring live accounts in the futures market. We'll come back to that at the end. So, my next question for you, Thomas, is one moment. Here we go. It's a simple question, or maybe it's not a simple question. Simple question, maybe sophisticated answer. Why? Why, Thomas? Why?
Yeah. And it's so funny because you're right. It is simple answer. It's simple question. It's simple answer. And I'm always blown, by the fact that so many people ignore it. So let's have a look. There are basically 3 reasons why strategies fail. So the first one is sample size, and this is something that sometimes some traders are stubborn about, and they do not understand it correctly. So let me give you an example. So sometimes a year ago, I had a chat with trader, and he was insisting on the idea that he only creates strategies on the last year of data, day trading strategy, because this is what the market looks like right now. It's closest to actual market is what's been happening the last year, and there's a merit in that. I cannot deny that. It's like there is something about that. But what this kind of traders, what they forgot is that it is now. So let's say in 2 months, markets can change completely. It can be a completely different story. We can enter a bear trend, which we entered a couple of months ago. Now, your last year was bear trend. So your last year was bear trend. Now you're in a bull trend, and you're working with sample size which never covered that scenario. Your volatility is double. You never covered that in your backtesting scenario, and you're experiencing strong fundamental facts like the war in Ukraine, which never was even close to that the year before. So the answer, there's only one answer to that, and that is that to create strategies, you need to build it on enough of a sample size. First of all, at least 10 years of history. Usually, from my experience, there's no point, especially with futures going further than 2007, because before 2007, there were a lot of things regarding data going on. There was implementation of overnight sessions, so the data are far away from what it is right now. But you need to go at least 10 years back to really cover all the scenarios, because whatever is going to happen next, there is a bigger probability that it was covered in one of these 10 years rather than the last year only. And then statistically, a good sample size to know that you have an edge is at least a couple of hundred trades. We often have, and you saw it already in previous series, that we often have 5, 6, 7, 8, sometimes 1 or 2,000 trade sample size, which gives us a lot of confidence that we covered all the different scenarios, volatilities, bear trends, bull trends, whatever, just name it. So that's one reason why traders fail, because they don't understand this simple rule of sample size. The second one is obviously, and that's very common, most common as well, is robustness testing. I still can't believe how people can, spend hundreds of hours when they want to make some kind of, purchase. So they want to purchase a certain thing, and they spend tens or sometimes hundreds of hours on Amazon, comparing prices, comparing benefits, comparing what this version does, what this doesn't. And they do it to save a couple of pennies. And then what happens with trading? They create a strategy and they put a couple of hours only to robustness testing procedures. So that's very important as well. The robustness testing is the most important part of the development process, and most of the time should be dedicated to robustness testing. In my framework, my robustness testing procedures are very tough and are the biggest part of the strategy development, because it goes way beyond this mentality of spending hundreds of hours when I want to make a purchase decision to know all the details and aspects and comparison and cheapest price. This goes even deeper, because you can lose. It's not about saving a couple of money. It's about the possibility to lose a lot of money very, very fast. And a lot of traders are still fall blinded with the vision of steadily upgoing equity curve, and they cheat their robustness testing procedures to support their bias towards this unrealistic vision. So whatever robustness testing procedures you're using today, there is one rule to that: step them up. Doesn't matter what you use, step it up. Unless you're using mine, which I know that quite a few already know from the Breakout Masterclass, which are one of the toughest in the industry and are comprehensive enough to do the job. And the third reason is adaptability. And again, something that not everyone understands. So markets keep changing, and you need to adapt to changing markets. So you always have to think, what is the way I can create my strategy adaptive? Like what is the easiest way to put some element into my strategy or process to support adaptivity in changing volatility, trends, economical situations, whatever. And there are basically two things. The first one is that you add adaptability element into the code, into the strategy, and mostly it can be a couple of things. It can be something as simple as, let's say, using average true range, which is a perfect one, probably one of my most favorite indicators ever, because average true range can keep change with volatility, and it's always present in my breakout strategies because it is highly adaptable element which worked and been working for ages. Or you can use something fancier, like develop your own auto-adaptive indicators, which is quite difficult job, but you can do that as well. But mostly with ATR and these simple things, you can already do a lot of job. Or somebody mentioned today the DPT, dynamic profit taking. That is a highly adaptable solution as well, because it uses pre-qualifier to pre-qualify market conditions and then change accordingly. But it's very advanced concept, very advanced. Or you might use other approach, not adaptability inside of the strategy, but in your robustness testing procedure, or in your adaptability re-optimization procedure, which means you regularly update or re-optimize your strategies. So you regularly assess the strategies, whatever your assessment process is, and update them, or you regularly re-optimize them based on very strict and exact re-optimization protocol that helps you with the adaptability as well. And of course, to create viable strategies that do work, you need to use all these trees. So only when you have all these trees, you can create strategies, which still some of them will fail. That's part of the business. It's not possible to have only winning strategies, but the failure rate will be very low, and you will be able to make viable business and income from your strategies.
Yeah. Thanks for sharing those 3 points, Thomas. They're they're good points to raise. But I noticed you've got a little comment underneath, which I think is complexity is often it's like a little side point, but it's such an important aspect, because I think complexity, a lot of traders assume that strategies need to be simple, and if they get too complex, then they break down. What do you mean by this comment here? Not necessarily complexity.
Exactly. So this is quite interesting, but exactly, you said it very well. A lot of traders, they think that their strategies are failing because they're too complex, and traders might be too biased towards super simple strategies. And I spent a lot of time on researching this idea of simple strategies. First of all, I never could prove that this would be the case. And second, many years ago, we did an analysis, or I did an analysis where I compared. No, actually, we did it in our hedge fund, where we compared the strategies between 1 and 7 optimizable inputs, and we couldn't see that a strategy with, let's say, 6 optimizable inputs would be necessarily significantly worse than with 2 optimizable inputs. So it it's not that much about that your strategy must not have any optimizable inputs and must be as simple as possible to avoid overfit, because you can overfit perfectly a strategy just when optimizable input as well. It's again about how you confirm whether the set of your optimizable inputs as a whole can readapt to ever-changing condition. Because in a sense, it doesn't matter if you want to, whether you want to readapt one input or 5 inputs. If these 5 inputs together as a whole have the power to keep readapting again as a whole, as one unit, to ever-changing market conditions and keep performing well, then doesn't matter. It doesn't matter whether you have 1 or 5, and that's the key philosophy. So you do not be overly biased towards strategies which are super simple or have just 1 or 2 optimizable inputs. It is good. A lot of strategies like that will grade well as well. That's for sure. But there's no evidence, at least from my research, that this simple strategy would overperform more complex strategies.
Yeah, that's an excellent point. And I remember when you first shared that research with me, it made a lot of sense. And kind of, I think in trading there are a lot of these things that people assume, and sometimes it can be the right opposite. So it's always worth testing out ideas. And I know you even was there an empowered trader issue like about 2 years ago? I think we called it the Mythbusters issue or something, didn't we?
Yeah,
And
yeah.
we tested a couple of these popular trader assumptions, and I don't, from memory, they weren't correct. So
This one was one of them. Yeah, this one
Yeah.
was one of them. Yeah.
Yeah, exactly. All right. So thanks for sharing that, Thomas. So I've got another question for you now. The previous question was why. This question,
What now?
what now?
Exactly. Right. So again, let me offer 3 simple answers. So first of all, when this happens, you always have to think about your capital. And the most important thing is that the number 1 rule is the capital preservation is always the highest priority. And I told you already what I did with this strategy many years ago, which went sideways. I switched it off, and although it recovered later on, I did not regret it, because I preserved my capital from this noise and nonsense and could use my capital to deploy a strategy which actually made money. So at Seikota, a phenomenal trader, one of my favorite of all times, he says the elements of good trading are cutting losses, cutting losses, and cutting losses. If you can follow these 3 rules, you may have a chance. And I think it's genius. It's so simple and so true. It's genius. So don't be stubborn. It very nicely ties back to the rule that we were talking about the last episode in crypto, about the stubbornness of trader, about their, for literally forcing the market to recover because they need their money back, which might or might not happen. Since then, we had just small. It's been 2 weeks. We had, I think, 2 or 3% move up. Obviously, the miracle has not happened since then. So the capital preservation is the highest priority always, and there's no harm in switching of strategy. So you always have to have clear rules and follow these rules and switch the strategy of when there's when it doesn't when it goes beyond your risk profile or beyond your rules. The next one, I just said 3 minutes ago, whatever your robustness testing procedure, except for the mine, if you're following mine, you should be all right. Step up your robustness testing. Whatever it is, just think how you can sit down tomorrow and think how I can step up my robustness testing procedures, how I can make it even harder. Take it like a challenge. It's like, people when they do these crazy workouts and these crazy what it is called, the CrossFit, when they do this CrossFit, and they pushing, and like who will push further, who will create a next challenge, who will beat that next challenge. It's same with robustness testing procedures. Whatever you have, like tomorrow, sit down and think how you can push it further and make something even harder on your strategies. You'll never regret this. This will be your biggest payoff. And lastly, improve the adaptability, which ties back to the adaptability rule, which is pretty simple. You just need to think how to incorporate adaptable or indicators with adaptable element into your trading, which the base is average to range, works fantastically. And whoever follows my Mr. Breakout's formula and is in breakout trading probably uses it anyway all the time. And this really is a great simple tool how to again improve adaptability and thus robustness of your strategies and mitigate a lot of situations when you have to suffer failing strategies.
Yeah. So in this example you've got here, under improved adaptability, you've got true range, which is a volatility measurement, I guess.
Yes.
Is that the main area people you think should research first, or is that the main area they should look at for adaptability?
I think they need to start with both. They need to start implementing these adaptive indicator, special volatility adaptive indicators or ideas, and then definitely think about robustness testing procedures, how to make it better or harder. And when I started with algorithmic trading, that was my goal for maybe first 2 years. I was thinking mainly about robustness testing procedures and researching and doing a lot of experience. That was probably the hardest part.
Okay. We got a couple of general questions in the chat, which I think we'll come back to just after we finish the next slide or two, Thomas, or do you want to do them now?
We can do them later.
So now, okay.
Yeah.
All right. So that was the 3 actions, what to do. And there's another one here. I can see the next slide. I'm peeking ahead a little bit. You want to cover that now?
Yeah.
Okay, let's go.
Yeah, this is a little bit of a commercial break, but I know, guys, that most of you on the show are serious, and many of you are already in the masterclass, so this is not for you. But if you're starting with trading and you need some proven beginners protocol for beginners, then recently we recorded a great breakout trading advantage workshop, which and it's very cheap. It's very cheap and affordable, which has proven breakout strategies model, explains in details to create both day trading and swing trading strategies with sufficient sample size, very important, with proven beginners robustness testing protocol, and with proven strategy development code with the adaptability element built in. So if you're starting out or not being lucky with the strategies that you built so far, just definitely consider this really good and inexpensive investment on gobettertradeacademy.com/advantage-replay this advantage workshop.
Yep.
Okay.
Thanks. Yep. Thanks, Thomas. So before we get into the quote of the show and the special major announcement, let's do a couple more questions from the chat. So, Olga shared a funny comment about the Whipsaw song by Ed Secoda. That's a very entertaining song. Okay, so this a good question from Jeffrey. Excuse me. If we build systems on a specific market and do optimization on this market, then we go and test this system on other markets. If we see good results, is that similar to the permutation process?
Yes, this is what we call cross stress testing or cross validation, and it's a very, very good test. But just this test alone might not be sufficient, but it's a very good start. It's definitely, it is better than nothing, and that already pushes you ahead of many traders and increases your chances of success.
Yep. And by the way, Jeffrey said in another comment something. He's forward testing his very first algo by watching the live show. So well done, Jeffrey.
Great. Proud of you, Jerry. Amazing.
Congratulations. Now, there was a question from Hutz or Hutz. I'm just trying to find it in the chat. Here we go. It's about monitoring live strategies. Or how do you monitor live accounts in the futures market? Is there an equivalent of my FX book or FX Blue for futures?
I'm not familiar with FX. I don't trade FX, so I don't know this. But TradeStation is quite good with monitoring live accounts. For the beginning, I used to use it for years and years and years. Definitely sufficient. And now in hedge fund, of course, we have more complicated solution that I cannot even explain because it was coded by my team and I don't even know all the details. But again, traders working with TradeStation, I would say it's quite sufficient for the job to get it done.
Yeah. I don't know much about MyFX book either because I don't trade forex. But I think one of the intentions of that platform is that you can lease strategies from the from the strategy developer. So there are similar things in the futures market. Like if you go to striker.com or Striker Securities, they're very well known in the industry for tracking the live performance of future strategies, and you can actually lease them in there as well. So I'm not sure visually if it's the same as MyFX book. From memory, I've seen a few screenshots and it looks like quite a nice platform, but there are websites out there that do similar kind of functions in futures. So, yeah. Now, so I had a question for you actually. So if you determine that a strategy has failed and you switch it off, do you ever go back later on and have a look to see how it's gone? And the second part of that is, would you ever consider switching a strategy back on if it recovers?
So the first part, yes, I do keep monitoring failed strategies because it's one of the greatest learning experiences. I keep monitoring them. I want to see if they recover, and if they recover, how fast. What was the circumstance? Where it recovered, at which point. Then I ask questions why it recovered here and not before. And it's really speeds up your understanding of markets and your learning curve. And as I said, we still keep all the failing strategies in our database in hedge fund as well, and keep learning from them. And we're assessing them separately as well to really learn from them as much as possible. There's it's a tremendous learning just from failing strategies. The second question, if I switch off a strategy, I usually do not get back to it, but I might with some strategies that I used to have in the past. Some of them I did modify a little bit and switch on an updated version. But sometimes that updated version had some new element, or it wasn't a subtle update. It kept still the core idea, but there could be some brand new element in it. So it was like version 2, version 3. So that's what I sometimes used to do as well. Now I don't do it because we have so many strategies that we can replace a failed strategies immediately.
Yeah, I like the perspective of that because sometimes we can get fall in love with our strategies and then they fail and we feel an emotional attachment to it, like we've been dumped like by a jilted lover or something. But I like the what you're saying there is you're actually using it as a positive experience to learn, and it's actually a good thing because you can improve your trading by observing these failed strategies, analyzing why they did fail, and identifying ways to improve. And I just noticed it links in quite nicely with your quote of the show. Do you want to talk about this one quickly?
We can skip the quote and talk about the major announcement later.
I thought it might be nice. Yeah, we'll go to the quote and come back.
Yeah. So the quote, do not be embarrassed by your failures, learn from them and start again, which you write. This links beautifully. And this is all of that it is really, because I think that every experienced trader will confirm to you that it was the failing strategies from what they learned the most, not the winning strategies. So even nowadays, if we have failing strategies, hallelujah, that means we still have more to learn, and that's always the good thing.
Yep, exactly. That's a good quote. So, Thomas, I think it's time.
Yes.
I wish I could do a drum roll, but it's a bit early in the day here. I don't want to wake the kids. Here we go. Major announcement. What is this, Thomas?
So, it's not for today, but guys, that this show is every second Tuesday, but we're going to hold a very special episode next Tuesday, same Tuesday, same time, everything the same, but it's going to be a special episode and we will do a major announcement. And I think, Andrew, that you will agree that I do not exaggerate if I say it's going to be announcement about nearly my lifetime work. Is that correct?
Yeah, I would
Pretty
say
much
so.
it is, isn't it?
Yeah, it's a huge announcement.
And a huge announcement about my lifetime work, and I think it's going to be hopefully revolutionary. So please join us next Tuesday. I'm not going to reveal anything else, but it is going to be a very special episode for sure.
Okay, and for those wondering what it may be, Thomas just dropped a hint in one of those sentences there, but I'm not going to tell you which one. All will be revealed next week.
So guys, let us know in chat who's coming next Tuesday, who will be here, so we already can be looking forward to you.
Yeah,
I think we'll have some delay, but hopefully we have someone already.
Okay, we got a couple.
Or a cliffhanger. Neil is always funny. I like Neil's comments. He's always so funny.
It's going to be great. It really is. Thomas is not, overinflating it. It's going to be a big announcement. So, Jeffrey, while we're impatiently waiting, Gary's going to be here. Hopefully, we'll see Olga. Are you coming, Olga? You've got to be there. You're going to love it. Okay, so let's move on from this major announcement. I think we've teased it enough, but make sure you get here next week, same time, same day of the week, and we're going to be here. Things are going to be a little bit different to our normal show because it's a special announcement show. All right, Thomas, so that looks like that's all the questions in the chat. Any closing thoughts before we wrap up? Actually, I've got one. If you enjoyed the show today, please remember to give us a thumbs up. Hang on, I've got a little thing to put on the screen here. Yeah, please give us a thumbs up and hit the subscribe and bell button so that you're notified when new content is released. And if you have any questions, I think I saw a question from you about walk forward in the modules. If you send that to support@bettertraderacademy.com, Kate will be able to answer that. She'll look and see what you've got access to. She'll point you in the right direction. Okay, so Thomas, any final words before we wrap this one up today?
Yes, I do have final words. By any means, guys, be here next Tuesday.
You don't want to miss it. You'll regret it.
I mean it.
All right, so we got some more yes to attending next week, and we got a big thumbs up from Jeffrey. Thank you, Jeffrey. So I'm glad that everyone attended today. Super important topic, failing trading strategy, something we all have to deal with. And if you can manage it properly, you become a better trader by default. So thanks for sharing all your points today, Thomas. As usual, super valuable information.
Thank you as well.
And do you have any final words? If not, we'll wrap it up.
Yes, next Tuesday.
See you next Tuesday. Have a good week. Bye-bye.
Next Tuesday.